Here we go, Money Talk.
Hello and welcome to the Financial Fitness Bunny podcast, your number one stop shop to all things money management. My name is Nicolette Mashile, also known as the Financial Bunny. And of course, I'm back again to put lipstick on the money pig. This week, I read a book called Train Your Way to Financial Fitness. It's written by Shannon Mcclay, and she's the founder of the Financial Gym. And I must tell you a story, if you've never heard this story. A couple of years ago, no, in actual fact, in 2019, I had an opportunity to travel to New York for a friend's birthday. And then me being me, I was like, I'm not going to go there just for fun times. Let me see if I can set up some meetings with a couple of notable financial brands. And one of those was the Financial Gym. So I wanted to tour the gym and see what it looks like. What is it that they do? What is their product or service offering? I sent them an email and they responded, which was actually quite a big shock to me. And I had an appointment. The moment I landed in New York, I went straight to the Financial Gym and they showed me around the area. They showed me what they do. They told me, listen, they do personal finance coaching with their clients. And but they wanted to tell me the story of their founder, and her name is Shannon Mcclay. So basically, what happened was Shannon Mcclay herself worked in the financial services sector. And while she was working there as a financial advisor in the corporate space, she realized that she herself was not in good financial shape, right? Despite having a successful career, she had what is called a disastrous balance sheet, and she was financially fat in her own words, right? By the way, she also makes quite a lot of comparisons between finance and fitness, right? Or maybe not fitness per se, but let's say the weight loss journey ultimately. So she makes quite a lot of these comparisons to say there are people who, when you do an audit of their finances, find out that they're financially slim, financially fit, or financially fat, or financially obese. And so she uses that metaphor of weight loss to be able to identify where somebody is in terms of their financial status, right? So, again, one of the things that they speak a lot about when they talk about Shannon is the fact that she did, I think, try The Biggest Loser. And when she did The Biggest Loser, it was easy for her to find information about your weight loss journey, support systems. But when she was trying to get herself financially fit, the issue was lack of resources, lack of places to be able to go to. And that is why she then created the Financial Gym. It was such an amazing thing. I actually came back to South Africa and I wanted to try it out. What I wanted to add for the South African mix was financial psychology, because what they had is financial coaching. Then if you needed any types of financial products to get you to a space where you can be financially fit, they would then recommend you to a financial advisor. And of course herself, she is a financial advisor, so she was able to assist you. Now, obviously, I'm not a financial advisor. So one of the things that I was finding was that I was leaving most of my coaching clients in a loop, because to really put the stamp on financial fitness, you do need a mix of some financial products. But I had I've got no licensing to be able to do that. Of course, no expertise either. So I was leaving my clients in a loop. So I had brought in somebody to do financial advisory. And then I thought, you know what? A majority of us, most of the financial decisions we make are deeply rooted in psychology, deeply rooted in trauma, deeply rooted in a level of attachment style that we may have. So you do need a financial psychologist to just sometimes speak to you. And I think financial issues sometimes, if somebody can just lend you an ear, it really changes the trajectory, because it gives you another set of eyes to be able to see what's actually happening with your finances. So this is what Shannon and them had done, so I wanted to replicate it. Unfortunately, I had done all of the replication, kind of had our own model going, and was supposed to launch in 2020 April. And of course, you know exactly what happened. We got COVID, hard lockdown, and that kind of fell flat on its face. Maybe I'll get back to it. I'll see. Maybe I'll definitely get back to it. One of the things that Shannon says in her book is that the first conversation that you need to have with yourself is understanding what it is that you want, and then discover what can be done so that you are able to get that. She says we can't always get what we want, meaning that we can't spend on every desire. We do need to choose and prioritize to secure a happy life plus a happy and secure financial future. I think that's one of the most important things. And today, that's what I want to talk a little bit about. We'll talk a little bit about how do you pick and choose some of the things that you need to invest in, for instance, to be able to secure that financial future. How do you not stick to one thing? I know Warren Buffett, there's a saying about Warren Buffett, I don't know how accurate it is, and he speaks about people who want to diversify, don't know what it is that they're doing. It's attached to him, whether he said it or not, I don't know. But I believe in diversification, and I'll start off here. You know, we talk a lot about additional income streams in a country like South Africa, but the reality is, in many of the jobs that we do, that's where we are actually being underpaid, right? Now, when you want to diversify, imagine 9 to 5 and you are in this corporate company, you're working as an employee, and then somebody says to you, you must diversify, you must add additional income. I mean, they say to you, you must add additional income streams. And you're sitting there and you're like, I can't take any another job. After spending 9 to 5 at work, and now I must take another job. Guys, it's really exhausting and taxing. So I then thought, you know what, maybe what we should be saying to people is diversify how you actually get your income. Diversify that you minimize some losses. Diversify so that you don't feel like you are being exhausted on a daily basis just to make money. I feel like there is no joy that comes from an income that feels like you had to labor so hard for it, that when you do the pros and cons of whether this money is even worth it, you realize that it actually does not feel worth it at all. So it's important to then try to diversify how you actually make your income. But maybe let's talk a little bit about, diversification and what exactly is it, what exactly does diversification look like, and why is it so important? Well, I think in the simplest terms, diversification is important because there's no one single investment that is guaranteed to perform well at all times. There's a gentleman by the name of Tony Robbins, and he created an all-weather investment approach, or all-weather investment portfolio. And basically, even if you look at that all-weather investment portfolio, what you realize is that he's got a diversified amount of assets in there as based from his asset allocation to try and actually derive these advantages of diversifying. So what are we talking about? When you're making a smoothie, there's no way you're going to make a banana smoothie and just blend a banana and that is it, right? You're going to add in an apple, you're going to add in, some strawberry, some yogurt. That's you diversifying in terms of taste of what it is that you want to eat in or drink in your smoothie. So it's almost similar. Like for instance, if you take the stock market, many people, if you are invested in the stock market, you must have at some point in your life chosen that one stock that does not do great as an individual stock. But somehow when you find that stock in an ETF or in the unit trust, it is almost camouflaged by the other stocks. So you don't really always feel, when there is a turbulence in that share price of that stock because it is covered by the other stocks. So that's what we talk about when we talk about, diversification. We know that if one investment performs poorly, the others may perform well, which can then help in balancing out the overall performance of your portfolio. So you can either diversify in terms of the stock market, diversify in terms of industry. For instance, you're not taking only just energy stocks or just food stocks or just banking stocks. You are diversifying in terms of having a very healthy mix in terms of that stock mix that you're looking for. But how do you go about in diversifying your portfolio? Well, there are several ways in which you can diversify your portfolio. One, it is to invest in a variety of different types of assets. So we're looking at your shares, we're looking at bonds, we're looking at real estate, we're looking at livestock, we're looking at cryptocurrency. You could even add in some trading in there, just so that you've got a different mix of how you are actually trying to derive income. So as I said, another way is to look at different industries. So technology, healthcare, finance, food, beverages. That's another way for you to be able to diversify. A third way is also by looking at regions. You could be localities, for instance. You could be heavily invested in the South African market, whereas you could diversify by going into the European market or the American market, Indian market, and that's really diversifying in terms of geographical locations. But of course, it depends on your risk management or risk appetite. So you can't copy somebody else's diversified portfolio just because it's a diversified portfolio and it works. Because some people don't have a risk appetite, for instance, for emerging markets. And if that person is diversified in bringing in some emerging markets into their fold, you may find it difficult to be able to hold on and not panic sell when something happens within those emerging markets. Or for instance, during the hard lockdown, we remember Sasol. It went through various fluctuations, right? So the share price also just went in, out, up, down, in, out, So you can't be the type of person that those are the markets or those are the industries that you really are averse to, and that's where you want to go into. So it's very important to make sure that you are keeping those things at the back of your mind. And I do think that it is worth it really speaking to an investment expert, somebody who, of course, is registered to be able to give you investment advice. Because those guys, that's their day-to-day. They sit there and they are looking at markets, they're looking at asset classes, they are looking at, what are the different economic environments that are created on a daily basis. They can project what their economic environments are. For instance, right now, a lot of people are looking for investments that can beat inflation, investments that can weather the high interest rates. So those are the things that you want to focus on, but you may not have the expertise. So you and I may not have the expertise to be able to do these types of things. So that's why you then bring somebody in, right? Somebody in to be able to assist you. I was actually talking to a farmer. Well, we call them a farmer because that is the formal word for it, right? But when you go to Ekasi or Marai, where I'm from, you find people that have livestock. They're not necessarily farmers, but of course they work in that space. So we call them small-scale farmers, right? Who have cows, who have sheep, who have different pigs and all of those things. Even within their cows, the types of cows that they keep, there is a diversification in there. So they'll have different types of cows, the Brahmans, the milk cows, the cows that are baby making, and I say baby making cows, but those cows that breed and they can handle gestation for that long and can actually help in expanding or at least giving you more cows over a couple of years. So those are the kind of things that you need to think about when we're talking about investing. Diversification is an important part of investing. So here are my top 10 tips in terms of diversifying. I think the first one is allocate across all different asset classes. Learn about those different asset classes. Know which asset class behaves in what manner when there is certain economic factors that are taking place around it. So how does the bond market react to increased interest rates? How does the stock market react to inflation? All of these things. How does the law of supply and demand affect stock, real estate, bonds, commodities, crypto, all of those things? Understand how they are affected by different economic environments so that you can have a good diversification strategy in terms of what it is that you are going to be investing in. The second one is, of course, be open to domestic, foreign markets, emerging markets, growth markets, all of those things so that you have an understanding of what it is that you can expect from them. The third one is spread your industry, spread across industries, spread across sectors. As I said, healthcare, transportation, banking, food, tech, all of those things are pharmaceuticals. All of these things are industries that can give you a level of exposure to a certain return, but they have a level of risk that is attached to them. But when you diversify them, you at least are buffering yourself from a full-scale, risk situation. Number 4, consider alternative investments such as private equity and hedge funds. Again, it is a conversation with a financial advisor, conversation with an investment specialist to say, what options do I have in private equity? What options do I have in hedge funds? Can I? And also remember, and referring back to another episode that we did, talking about Nick McGreely's book, which is Just Keep Buying. One of the things he said is the amount of time you invest in finding the right investment is dependent also on the income level that you are at. So how much do you have to invest? If you only have, for instance, 1,000 Rand to invest every single month, of course, then hedge funds are probably not where you should be putting your money. So don't spend too much time trying to invest in hedge funds or understanding them, where right now you should be focusing on increasing that income so that you can unlock those types of investment options. So this time at 1,000 Rand, you could be looking at maybe a a 60-40, 60% goes into maybe a stock, a mix, an ETF or a unit trust. And then your 40% could be going into even a money market, or you could be putting it into bonds, whichever one works for you. But I think at that point, don't overcomplicate investing for yourself, right? The fifth one is use actively and passively managed funds. I think the more you take out stress from investing, the better. But also look at the cost implications, because many of these funds, their mix is the same. Great fund managers generally have a great investment strategy, right? And in that great investment strategy, they can justify why they've done certain things. So some of these funds may look a bit alike, but the fee structure is also going to really determine whether or not you're going into them or not. Try to rebalance regularly to maintain desired asset allocation. So a good financial advisor, and this was told to me a couple of years ago, and I think it was by my wealth expert. His name is Mdu Lutuli from Lutuli Capital. And he said a good financial advisor is one that is able to see ahead of time where a rebalancing might be needed, right? Even within asset classes, like for instance, if you are investing in buy-to-let property, you do need to diversify. Have some studios, have 1 bedrooms, 2 bedrooms, bottom floor, garden floor, top floor, localities, class them, A, B, or C properties, Kasi properties, township properties, a town, suburbs, student accommodation, commercial property. Yes, it may be better to stick to one because you think you know it. Like for instance, I stuck to residential property for too long. And if I look at my yields, I don't think it's worth it. So I could have diversified in terms of, okay, maybe I need a commercial property somewhere in there, to see what are the types of returns I can get from commercial property. It's also important to avoid putting too much in one security or an industry. And the only way you can do this calculation is by really sitting down, asking yourself, how much do I have to invest every single month? Then putting it down in terms of the investments that you currently have. You do what is called asset allocation or asset allocation assessment, where you actually check where is the majority of your money sitting in. And I can tell you now, my majority of my money is sitting in property. Almost 80% of my money is sitting in property. But what happens if the property market goes pear-shaped? So these are some of the things that we've got to think about when we're talking about diversifying and investing our own hard-earned money into assets that are going to bring us actual returns. Make sure that also you consider a rand cost averaging approach. This is where you pick a certain amount of money, especially when you're still in the lower incomes or lower investment allocation income. If you've got 1,000 rand every single month, make sure that you are putting in the 1,000 rand every single month, because it will give you the returns. I always say in unit trusts and ETFs, when you are buying consistently every single month the same amount of money, one of the things that is going to ultimately happen is that there will be a month where there's going to be a big sale and you can buy literally anything that you want at that low price. When the market rebalances itself out, all of a sudden you've got more in your portfolio than you would have had if you actually readjusted how much you invest if there was, a drop in the market. So for instance, if you're buying cows are worth 50 rand a cow, and with 500 you are buying 10 of them. But the day the cow price drops and it drops to 10 rand a cow, you are able to buy 50 cows that month. But when it rebalances back to 50 rand a cow, all of a sudden now you've got 60 cows multiplied by 50 rand. Do you get what I'm saying? That's how this idea of rand cost averaging works. So it's very, very important that you actually just think a little bit about what it is that you're doing. And I always say to people, don't overwhelm yourself. Get a financial advisor to assist you, to get a financial advisor to give you the right advice. But most importantly, be involved in what it is that you are doing so that you know exactly what to expect. I think often too many of us leave and we outsource this part of our finances to somebody else, and then we just hope for the best. Make sure you don't have that ostrich mentality where you're keeping your head low and you're hoping that something comes out of it. Anyway, I'm going to leave it here. Thank you very much for listening to Yes, Your Money Does Matter, a financial fitness bunny podcast. Do remember, this is not financial advice. If you are looking for financial advice, please do speak to somebody who is certified and registered with the FSCA to be able to give you that financial advice. Until next time, happy investing, and I'll see you guys on the next one.